Hello and welcome to the Daily Brief. On this show, we cut through the noise and simplify the biggest stories and trends that are shaping the markets. I'm your host Tarun. Today is Thursday, 22nd August, and I have four big stories for you. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. And if you like reading instead of watching or listening, you can subscribe to our No Spam newsletter for a quick rundown. You can find all the links in the description. So let's start with the stories. I first talk about the relentless rise of Indian investors. Then I discuss if India is open for business. I then move on to again talk about unemployment. And finally, I talk about what the RBI governor said. So, first, let's talk about the relentless rise of Indian investors. Since COVID, the Indian markets have transformed dramatically. In fact, in the 5 years since COVID, our markets have grown as much as the previous decade. Recently, NSE published some interesting data on investor growth and ownership patterns of Indian equities. So I figured this is a good chance to look at how the Indian markets have changed and put some numbers to it. In July, the Indian markets reached a new milestone. The total number of unique investors reached 10 crores for the first time. But here's the surprising part. In 2013, the Indian markets had just 1.5 crore unique investors. By 2020, this had hit 3 crore. So it took 7 years for the users to double. But by 2022, the number of unique investors had doubled to 6 crores. So it only took 2 years, and by 2024, we are at 10 crore unique investors. In fact, it only took 5 months for the last 1 crore investors to be added. That's some stunning growth. The other stunning statistic is the ownership pattern of Indian equities. For a long time, FIIs or foreign institutional investors like international asset managers, pension funds, sovereign wealth funds, and hedge funds were the largest holders of Indian equities aside from promoters. But this is changing. As of June 2024, the FII share of ownership of NSE listed equities was 17.4%. This is a 12-year low. On the other hand, the ownership of Indian equities by DIIs or domestic institutional investors like mutual funds, insurance companies, and pension funds like EPFO hit a new high of 16.2%. The gap between FII ownership and DII ownership is just 1%, and DIIs will overtake FIIs in a few quarters. Of this, mutual fund holdings of Indian equities stood at 9%. For context, this was just at 3.6% in 2009. This is thanks to the rising popularity of SIPs. On average, net SIP inflows are about 8,500 to 9,000 crores a month. It's the same story when you look at retail ownership as well. Retail investors now hold a record 7.6% of Indian equities. Here's a stat that is even more stunning. From 2013 to 2017, individual investors were net sellers of equities. The net outflows were 1.8 lakh crores. But since 2020, they've been net buyers and have bought equities worth 3.9 lakh crores. By the way, this is excluding retail investments in mutual funds. If you look at FIIs, since 2021, they've invested about 87,400 crores. DIIs have invested 8.5 lakh crores and individual investors have invested 3.7 lakh crores. So even though FII ownership of Indian equities has been reducing, DIIs, mutual funds, and individual retail investors have more than made up for it. This is a stunning change in the ownership pattern of Indian equities. Now let's move on to the second story and discuss if India is open for business. India is at a stage where if it has to achieve its potential, it needs to do a lot of things. We need to learn how to build and manage world-class businesses, working with cutting-edge technology, and then produce products and services that can sell in the best markets. And most importantly, we need lots and lots of money. Today's advanced Western countries took over 2 centuries to get where they are. But for the last 50 years or so, there's been a shortcut. And that shortcut is foreign investment. Foreign investors supply the funds necessary to build factories, logistics networks, invest in research and development, and everything else that India will need for its own development. But they also bring in knowledge, teaching Indians the best ways to do business from the experience they've gathered across the world. Many of Asia's economies that have grown spectacularly, like the Asian tiger economies of South Korea, Hong Kong, Taiwan, and Singapore, got to where they are due to massive foreign investments. India is trying to follow this playbook too. Its journey has been far from straightforward though. Before the global financial crisis, India had seen a sharp, steady increase in foreign investment. This trend abruptly reversed after 2009. FDI as a share of the Indian economy has never recovered to the same levels. While foreign investments hasn't kept pace with India's growing economy, in absolute numbers, investment into India was still looking upward. Gross investment inflows, which is the money investors put into India, hit a high of 84.8 US billion dollars in the financial year 2022. But then things reversed. Last year, direct investment into India was at 26.6 billion US dollars, which was the lowest India has seen since financial year 2007. This was for two reasons. One, the money coming into India had fallen substantially to 71 billion US dollars. Two, investors pulled out 44.4 US billion dollars out of the country, almost twice as much as they had before. There are many reasons for this decline. For one, the global economy has changed. Globalization is on the retreat in many parts of the world, and the global economy has seen serious headwinds over the last few years. But that doesn't explain everything. While global FDI fell 2% in 2023, investments into India fell by 43% over the year. In 2022, India got the eighth most investment in the world. In 2023, it dropped to 15th. Its share of global investment has also fallen substantially in the last couple of years. Here's India's big challenge. You can't force foreign investors to do anything. They don't live here, and India isn't entitled to their money. The only way to attract them is to make India a great place to do business. It isn't enough to show them how large a market India is. They need to believe that India's regulations and policies will allow them to be stable and help them flourish, and that the government won't create unnecessary headaches for them. The Indian government, unfortunately, is known to make things hard for businesses. Despite the liberalization of our economy a few decades ago, businesses still need to crawl through miles of red tape to get anything done. Just in the last couple of months, tax officials have gone after numerous companies for trivial issues, like sister companies in a conglomerate using the same name. India has also not been a fan of investment treaties that safeguard foreign investors. In 2016, it cancelled 76 of its 83 bilateral investment treaties. Now, there's some good news. In financial year 24-25, so far things have been much better than financial year 23-24. In the June quarter of this year, gross investment inflows into India were at $22.5 billion, up from $17.8 billion in the same quarter last year. Net FDI as a whole jumped up from $4.7 billion to $6.9 billion. At the same time, though, investors withdrew $6.7 billion from Indian markets in June 2024 alone, the most they have ever in any month on record. So, do you think we are finally heading towards more investment, or are we just scaring investors away? It's hard to know for sure, but one thing's clear. We need a lot more investments than we are getting. Now, let's move on to the third story and again talk about unemployment. One of the hot button topics in national politics right now is jobs. Indians don't have enough ways to make a living, and people argue that this is stifling India's economic potential. As politicians fight over Indian employment numbers, we have some numbers to look at. Every quarter, the government comes out with a periodic labor force survey where it looks at the state of urban employment. Here's how things are looking. Of India's 1.4 billion people, around 900 million Indians are of working age. The rest of India is either too old or too young to work. However, not all of these 900 million are part of our labor force. Not everyone who can work actually does so. Our labor force is made up of people who are working or those who are actively seeking work. India has a problem here. Our labor force participation rate, which is the proportion of working age adults that are in the labor force, is incredibly low. It is, however, increasing steadily. It's been over 50% for more than 2 quarters. Even though this is far lower than the global average of 61%, it is still better than it has been in a long time. Similarly, our working population ratio, or WPR, which is the proportion of working age adults that actually have work, has been going up by 1% a year. So more Indians seem to be working than before. But this still means that almost half of our working age population isn't in the labor force, and a majority of working age Indians don't have work. But why? There are many reasons why people don't work. They might have physical or mental challenges, or might be studying or preparing for competitive exams. Or they might simply have given up on ever finding a job. Perhaps the biggest problem for India is our horrible gender ratio at the workplace. There's always been a massive gap between the proportion of Indian men and women who work. In the June quarter, more than 70% of Indian men were working, compared to just 23% of Indian women. Worrying as this trend is, there's been a slight improvement over the last couple of years. Something seems to have happened over the pandemic that has nudged a lot more women to work. June was the eighth straight quarter when women's labor force participation increased far quicker than that for men. Since June 2019, the worker population ratio for men has gone up by 3%, but for women, it is up by 6%. Our unemployment rate has been steady at 6.7%. This is more impressive than it looks because our workforce is growing larger. See, percentages only tell you so much of the story. The overall size of the pie matters. 94% of India's labor force was employed last year, and 94% of India's labor force is employed this year as well. But crucially, India's labor force has become bigger. To keep its unemployment rate exactly where it was, India has created hundreds of thousands of new jobs over the last year. But there are two caveats to consider here. One, a country's unemployment rate is a measure of all the people in its labor force without a job. The unemployment rate doesn't measure the percentage of a total population that isn't working. It limits itself to those who actively seek work. By this criteria, you're only unemployed if you're out there looking for work but haven't found any. If you'd like some work but are just lying around at home, discouraged instead of searching for jobs, you aren't part of the labor force, and so you aren't counted amongst India's unemployed. Two, the PLFS sets a really low bar for who's working. If someone has worked for a single hour in the last week, according to the government, they're employed. Many people who would consider themselves unemployed would, for the purpose of this survey, seem to be working. Even so, directionally, it looks like India's employment picture is getting better. Now, for the last story, let's listen to some of the things the RBI governor has to say. Shaktikanta Das, the governor of the Reserve Bank of India, recently did an interview with NDTV Profit. So, when the RBI governor speaks, we have to pay attention because whatever the RBI does, it will directly affect our wallets. The governor spoke about many of the important issues we've spoken about on the show, from inflation to credit growth, etc. So let me highlight some things that he talks about. I'll first start with inflation. But before that, some quick context. Inflation is one of those things that affects just about everything in our lives. Prices going up mean everything from the cost of our morning coffee to the interest on our credit cards go up. In July, headline inflation fell to a 5-year low of 3.5%. For context, in July 2023, this number was at 7.44%. Now, at first glance, that sounds like great news, right? But let's break down why this number looks so impressive. It's largely because of something called the base effect. Simply put, last year's inflation was really high. So when we compare this year's figures to that, even a small decrease seems like a big drop. But this effect is temporary, and once the base levels out, inflation will go back to its usual trend. A big part of why inflation was so high last year was because of the rising food prices. There were supply chain issues, heat waves, lack of rain, pest infestations, you name it. Anything that could go wrong went wrong. Food and beverages make up 45% of the inflation basket, and this pushed up the headline inflation. But this year, the monsoon has been above expectations, and the hope is that food prices will come down, bringing overall inflation down. Here's what Das said on growth and inflation. The RBI's target is to keep inflation around 4% over the long term. Even if inflation dips below 4% temporarily, it doesn't mean things are all right. This could just be a short-term dip, so the RBI won't start cutting interest rates just based on 1 month's inflation data. He also points out that even if the core CPI, which excludes food prices, shows lower inflation, it doesn't mean inflation is fully under control. For most people, food prices are a significant part of their daily expenses, so ignoring them doesn't give a true picture of the cost of living. Despite the high inflation, he said that India can grow at about 7.2%. The governor made it clear that the RBI is taking a patient and careful approach. They're not going to rush into cutting interest rate decisions based on temporary changes in inflation because that could lead to bigger issues down the line. He also spoke about deposit and credit growth. He said that while credit growth, that is, loans given by banks, is strong, deposit growth is lagging. This gap could potentially lead to liquidity issues in the future. He further clarified that while this isn't a problem yet, banks need to carefully monitor this trend and manage their liquidity to avoid future challenges. He also said that young Indians are increasingly investing in stocks, mutual funds, and insurance products rather than just keeping their money in bank deposits. This shift is partly due to greater confidence in the economy and the availability of new financial products. While this is a positive development, it also means banks need to adapt by offering more attractive deposit products to compete with these alternative investments. He also spoke about the massive problem of illegal loan apps. In the last 4 or 5 years, there have been hundreds of illegal apps that make it easy for people to borrow money. But when users sign up, these scammy apps also get access to the user's contacts, photos, videos, etc. Once the loan is taken, these illegal loan companies start harassing people in the contact list, morphing pictures, and much more. These apps have become a societal nuisance. He said that the RBI has been working closely with banks and non banking financial companies or NBFCs to monitor and control the spread of illegal loan apps to ensure that these financial institutions do not unknowingly get involved with or support unauthorized lending practices. Finally, he also touched on fintechs. In the last year, the RBI has been closing several regulatory loopholes that fintech companies have exploited. Just this week, it cracked down on peer to peer lending. When asked about the stringent actions of some of the fintechs, he mentioned that while the RBI encourages innovation in the fintech space, it is also essential that fintech companies operate within certain guardrails. These regulatory boundaries are in place to preserve financial stability and protect consumers. For instance, some fintech models might build up risks over time, and the RBI needs to intervene early to prevent these risks from escalating. And that's it for today's episode. We'll see you in the next one.